In the previous section, you explored the mortgage market, where the money for home loans comes from, how the Federal Reserve influences interest rates, and how the primary and secondary mortgage markets interact through organizations like Fannie Mae, Freddie Mac, and Ginnie Mae. Now we shift from where the money comes from to how that money is actually lent to real estate consumers. This chapter focuses on the types of real estate loans, their structures, and the lending programs most commonly seen in residential transactions. As a real estate professional, you won't be the one actually underwriting or issuing loans, but you must be able to explain the basic differences between loan types, spot red flags, and help clients ask the right questions of their lenders. You also need to recognize when a particular property is or is not eligible for the type of financing your buyer is using. Introduction: Jan's first home and mortgage choices. After years of working and saving, Jan is finally ready to buy her first home. She attends a homebuyer seminar where the speaker starts with a simple definition. A mortgage is a loan secured by real property, used to finance the purchase or refinance of a home. The speaker explains that every mortgage has a few core components: principal, interest, and loan term, and that buyers often choose among several major loan programs, including FHA-insured loans, conventional loans, VA-guaranteed loans, and sometimes USDA loans in eligible areas. Understanding these options helps buyers compare not only monthly payment, but also total cost and eligibility rules. Components of a mortgage loan. When a buyer finances a $100,000 home, the amount actually borrowed is the principal. The lender charges interest on that principal as the cost of borrowing money. The interest rate a borrower receives depends on factors such as income and job stability, credit score, and history. Existing debt, debt-to-income ratio. Loan type and term, 15-year versus 30-year, fixed versus adjustable. The loan term is the length of time the borrower has to fully repay the loan. Most residential mortgages are 15-year, shorter term, higher payment, less total interest. 30-year, longer term, lower payment, more total interest. For example, if Jan borrows $100,000 at 5% interest, 15-year term, higher monthly payment, but much less total interest paid over the life of the loan. 30-year term, lower monthly payment, but significantly more total interest over the life of the loan. From a tax standpoint, interest on a primary residence or qualified second home may be deductible under federal tax law, subject to current IRS limits and rules, which can reduce the borrower's taxable income. While you should never give tax advice, you should know that many borrowers factor this into their decision when comparing loan options. Federal Housing Administration, FHA insured loans. An FHA loan is a government-backed mortgage program administered by the Federal Housing Administration, part of the U.S. Department of Housing and Urban Development, HUD. FHA does not lend money directly. Instead, it insures loans made by FHA-approved lenders, reduces lender risk if a borrower defaults, allows more flexible borrower qualification than many conventional loans. Key features of FHA-insured loans. Designed to help first-time and moderate-income buyers, but available to any qualified borrower, minimum down payment is generally 3.5% of the purchase price or appraised value, whichever is less. The property must be owner-occupied as the borrower's principal residence. Loan limits are set by HUD and vary by county and property type. Loans must be within these limits. The property must meet FHA minimum property standards and be appraised by an FHA-approved appraiser. Because FHA is insuring the lender against loss, the borrower pays mortgage insurance premiums, MIP, an upfront mortgage insurance premium, often financed into the loan. An annual MIP, paid monthly as part of the payment FHA loans typically allow. Higher loan-to-value, LTV ratios, smaller down payment, more flexible credit standards compared to many conventional loans. Other important FHA points. Maximum loan term, is typically 30 years on standard residential FHA loans. Prepayment is allowed without penalty, though lenders may require notice. Assumability. Many FHA loans are assumable, but newer loans require the new borrower to qualify with the lender. From a real estate licensee's perspective, you should also be familiar with the FHA amendatory clause and appraisal contingency language that protects the buyer if the property does not appraise at or above the purchase price. If the FHA appraisal is low and the seller will not reduce the price, the buyer may cancel the contract without penalty and recover their earnest money. Conventional loans. A conventional loan is any mortgage that is not insured or guaranteed by a government agency like FHA, VA, or USDA. Many conventional loans are designed to meet the standards of the two major government-sponsored enterprises, GSES, Fannie Mae, Federal National Mortgage Association, Freddie Mac, Federal Home Loan Mortgage Corporation. These conforming conventional loans follow GSE guidelines for maximum loan amounts, loan limits, adjusted periodically, minimum credit scores, maximum debt-to-income ratios, down payment and reserve requirements. Key characteristics of conventional loans often require higher credit scores than FHA down payments, commonly range from 3% to 20% or more, depending on borrower profile and product. If the borrower's LTV exceeds 80%, most conventional loans require private mortgage insurance. PMI can generally be removed once the LTV falls below about 78 to 80% by schedule or borrower request, which can reduce the monthly payment. Conventional loans can be used for primary residences, second homes, and investment properties. Compared to government-backed loans, conventional loans often offer more flexibility in property type, investment property, second home, 2 to 4 units, etc. A wide range of fixed rate and adjustable rate options potentially lower long-term costs for financially stronger borrowers. However, conventional loans can be harder to qualify for if the borrower has lower credit scores, higher debt-to-income ratios, limited down payment funds, Veterans Affairs, VA, guaranteed loans. The VA loan program, administered by the U.S. Department of Veterans Affairs, does not lend money directly, except in limited circumstances. Instead, VA guarantees a portion of the loan made by VA-approved lenders, reduces lender risk, allowing more favorable loan terms for eligible borrowers, who may be eligible: qualified veterans, certain active duty service members, some National Guard and Reserve members, certain surviving spouses. Key features of VA guaranteed loans: often no down payment required, up to the borrower's available entitlement and lender's guidelines. No monthly mortgage insurance, which can significantly reduce the payment compared to low down payment conventional or FHA loans. The borrower usually pays a VA funding fee at closing, which may be financed into the loan, with some exemptions for qualifying disabled veterans, maximum loan terms up to 30 years for typical residential properties. Property must meet VA minimum property requirements and be appraised by a VA-approved appraiser. Loans are generally for owner-occupied properties. The VA reimburses the lender for approved losses up to the guaranteed amount. If the borrower defaults and foreclosure sale proceeds, do not cover the balance issues a certificate of eligibility, COE, to show how much entitlement the veteran has available. Many VA loans are assumable, but assumptions typically require lender approval and may not automatically release the original borrower from liability unless the VA grants a release. USDA loans, rural development loans. The U.S. Department of Agriculture, USDA, supports home ownership in eligible rural and some suburban areas through its rural development housing programs. USDA loans are designed for low to moderate income borrowers who are purchasing in eligible locations. USDA loans generally provide 100% financing, no down payment, for eligible borrowers and properties. Competitive fixed interest rates lower monthly mortgage insurance costs compared to many other low down payment loan types. Basic USDA features. Borrowers must meet income limits, generally not exceeding a certain percentage of area median income. The property must be owner-occupied as a primary residence. The home must be located in a USDA-eligible rural or semi-rural area as defined by the program. Borrowers typically pay an upfront guarantee fee and an annual fee, similar in concept to FHA's MIP, which helps fund the program. USDA loans can be an excellent option for first-time or moderate income buyers in eligible areas who need zero down payment, prefer a fixed-rate, fully amortizing loan, want lower ongoing mortgage insurance costs than some other programs. Mortgage loan originators and their role. A mortgage loan originator, MLO, is the professional who works directly with borrowers to take loan applications, gather and review income, asset, and credit documentation, help determine which loan options may fit the borrower's circumstances, communicate with underwriters and processors within the lending institution. MLOS may be employed by banks, credit unions, and mortgage companies, mortgage brokers who arrange loans with multiple lenders. Key points about MLOS: must be licensed or registered under federal and state laws and follow strict regulations. Must comply with laws like the Truth in Lending Act, RESPA, ECOA, and related regulations. Must provide required disclosures and help ensure borrowers understand high-risk features, such as adjustable rates, balloon payments, prepayment penalties, where allowed, and mortgage insurance. From an agent's perspective, your responsibility is not to originate the loan, but you should encourage buyers to work with reputable, properly licensed loan originators. Make sure buyers understand that both the borrower and the property must qualify for certain loan types. Watch for issues like a condo that is not FHA or VA approved, which can derail financing if the buyer is relying on that loan type. Common loan structures beyond the loan program. FHA, VA, conventional, USDA. Loans differ in how principal and interest are structured over time. Some of the most common structures are fully amortizing loan. In a fully amortizing loan, each monthly payment includes both principal and interest. Over the term of the loan, the balance gradually decreases. At the end of the term, the balance is zero. Most standard 15 and 30-year mortgages are fully amortizing. Partially amortizing loan. In a partially amortizing loan, monthly payments reduce the principal, but not enough to pay the balance to zero by the end of the term. At maturity, the borrower must make a final lump sum, balloon, payment to pay off the remaining balance. Negative amortization. Negative amortization occurs when monthly payments are less than the interest due for that period, so unpaid interest is added to the loan balance. The result? The principal balance increases over time, can occur with certain adjustable rate or graduated payment loans. Fixed rate loans with a fixed rate loan. The interest rate stays the same for the entire term. Principal and interest payment remains constant, though escrow portions for taxes and insurance may change. Offers payment stability and predictability. Adjustable rate mortgages. ARMs. With an ARM, the interest rate can change at predetermined intervals, based on an index plus a margin. Key ARM features. Initial fixed period, e.g., 5/1 ARM equals fixed for 5 years, then adjusts yearly. Caps on how much the rate can change at each adjustment and over the life of the loan. Typically lower initial rate than a comparable fixed-rate loan, but more uncertainty. Interest-only loans. An interest-only mortgage allows the borrower to pay only interest for a set period, for example, 5 or 10 years. After that, payments may increase significantly. The borrower must begin paying principal as well. These loans can increase payment shock risk if the borrower is not prepared. Senior and junior loans, when multiple loans are secured by the same property. The first, senior mortgage, has the highest lien priority. Second mortgages, home equity loans, or HELOCs, are usually junior liens, paid only after the senior lien is satisfied in foreclosure. Junior loans are riskier to the lender and often carry higher interest rates. Graduated payment loans. A graduated payment mortgage starts with lower payments that increase over time according to a schedule. Early payments may not fully cover interest, causing temporary negative amortization. Then later payments rise to fully amortize the loan. Seller financing and creative structures. Sometimes the seller plays the role of lender, providing seller financing to help the buyer purchase the property when traditional financing is unavailable or impractical. Common forms of seller financing include purchase money mortgage. The buyer gives the seller a note and mortgage for part or all of the purchase price. The seller takes back a lien on the property, can be a first or second junior lien. Useful when buyer lacks sufficient cash or when conventional loan terms are unfavorable. Wraparound mortgage. In a wraparound, the buyer gives a new, larger note and mortgage to the seller, who continues to pay the underlying first mortgage. The new loan wraps around the existing loan. Buyer pays the seller. Seller pays the original lender. Can create risk if the seller fails to forward payments or if the first loan has a due on sale clause. Contract for deed. Land contract. Under a contract for deed, the seller retains legal title. The buyer receives equitable title and possession while making installment payments. Title is transferred to the buyer only when the contract is fully performed. These arrangements can be useful, but may involve significant risks, including forfeiture issues and difficulty for the buyer in establishing equity if default occurs. Special purpose loans. Certain loans are designed for specific situations or needs. Home equity loan /HELOC. A home equity loan or home equity line of credit, HELOC, uses the borrower's equity in a property as collateral. Often a junior lien behind the first mortgage can be structured as a fixed amount loan or a revolving line of credit, frequently used for home improvements, debt consolidation, or investment capital construction loan, a construction loan. Finances the construction of improvements. Is usually short-term and interest-only. During construction funds are dispersed in stages. Draws, as the project progresses, is typically paid off or taken out by a permanent long-term loan once construction is complete. Bridge, gap, loan, temporary loan. A bridge loan covers temporary financing needs, such as the period between completing construction and securing permanent financing, or between buying a new home and selling the old one, is usually short-term and higher interest due to increased risk. Participation loan. With a participation loan, the lender receives a share of the income or a share of the equity or appreciation in exchange for providing more favorable loan terms, such as lower interest or higher LTV, common in commercial or income-producing properties. Permanent takeout loan. A permanent loan is the long-term mortgage that replaces a construction loan, pays off the construction lender, and becomes the borrower's primary long-term financing. Reverse mortgage. A reverse mortgage allows a homeowner, typically a senior with substantial equity, to receive monthly payments or a line of credit secured by their home. No monthly payment is due as long as the borrower lives in the home and meets program requirements. The loan is repaid when the borrower moves out, sells the home, or dies, usually from sale proceeds. Blanket mortgage. A blanket mortgage covers more than one parcel of real estate, such as multiple lots in a subdivision. Often includes a partial release clause, allowing individual parcels to be released from the mortgage as they are sold and portions of the loan are paid down. Package mortgage. A package mortgage secures both real property and personal property. For example, a furnished condo where the furniture and appliances are included. Shared equity mortgage. A shared equity arrangement allows an investor, relative, or institution to contribute funds, often for the down payment. In return, they receive a pre-agreed share of the property's future appreciation or equity when the property is sold or refinance, closed-end versus open-end loans. Another way to classify loans is whether they are closed-end or open-end. Closed-end loan has a fixed amount borrowed and a fixed end date. Typical examples: mortgages, auto loans usually have lower interest rates because the lender knows exactly when and how the loan will be repaid. Open-end loan functions more like a revolving line of credit. The borrower can draw up to a limit, repay, and borrow again. Examples: credit cards, HELOCs, higher interest rates due to uncertainty about balance and repayment timing, but offer more flexibility. Borrowers often use closed-end loans for large, long-term purchases like homes, and open-end loans for short-term cash needs or fluctuating expenses. Secured, unsecured loans are also categorized based on whether they are secured by collateral, secured loan, backed by an asset, such as real estate or a vehicle. If the borrower defaults, the lender can foreclose or repossess the collateral. Examples: mortgages, car loans, many home equity loans. Unsecured loan, not backed by specific collateral, lender relies primarily on the borrower's creditworthiness. Examples: credit cards, personal loans, some lines of credit. Real estate loans are almost always secured by the property through a mortgage or deed of trust. Hard money loans. Hard money loans are short-term, high-interest loans made primarily by private lenders or investors, based more on the value of the collateral, the property, than on the borrower's credit profile. Typical uses: fix and flip investors who plan to renovate and resell quickly. Situations where a borrower cannot qualify quickly enough for traditional financing. Time-sensitive deals where a conventional loan would take too long. Characteristics: higher interest rates and fees, lower loan-to-value ratios, often 50% to 70% of the property's value. Short terms, often 6 to 24 months. While hard money loans can solve short-term problems, they are usually not suitable as long-term financing due to their cost. A common strategy is to use hard money to acquire and improve a property, then refinance into a traditional loan once the property and borrower qualify. Major agencies and programs. Summary. Throughout the previous chapters and this one, several key agencies and programs have appeared. As a quick summary, FHA, Federal Housing Administration, insures approved lenders against losses on certain residential loans, enabling smaller down payments and more flexible credit standards. VA, Department of Veterans Affairs, guarantees a portion of loans for eligible veterans and certain others, allowing zero down, no monthly MI loans in many cases. HUD, Department of Housing and Urban Development, oversees FHA and various housing programs aimed at promoting fair housing and home ownership. Fannie Mae, FNMA, and Freddie Mac, FHLMC, buy mortgages from lenders and package them into mortgage-backed securities, supplying liquidity to the mortgage market so lenders can continue making new loans. Ginnie Mae, GNMA, guarantees certain mortgage-backed securities backed by FHA, VA, and other government-insured or guaranteed loans. ECOA, Equal Credit Opportunity Act, prohibits discrimination in credit transactions based on protected characteristics such as race, color, religion, national origin, sex, marital status, age, or receipt of public assistance. CFPB, Consumer Financial Protection Bureau, regulates many consumer financial products and implements rules like TILA-RESPA, Integrated Disclosure, TRID, supervising lenders and enforcing consumer protection laws. These laws and agencies connect directly to the loan types and structures you see every day in real estate practice. Closing disclosure and TRID timing. Practical application under the TRID rules. TILA-RESPA, Integrated Disclosure. Regulated by the CFPB, residential borrowers must receive a loan estimate shortly after application, a closing disclosure, CD, at least 3 business days before loan consummation. Signing. Key timing points. The 3-day CD rule is based on business days, often including Saturday, depending on lender definition. The day the borrower receives the CD is counted as day 1. The borrower generally cannot sign loan documents until after the 3-day waiting period has passed. In practice, this means if closing is scheduled for Friday, the CD typically must be received by the borrower no later than Tuesday, or earlier, depending on how days are counted. To avoid delays, many contracts also require loan documents to be at the title company a set number of days before close of escrow. So planning and communication with the lender are critical. As the agent, you are not responsible for preparing the CD, but you are responsible for watching the timeline, communicating with the lender, escrow, and your client, helping set realistic expectations so that the TRID timing rules do not cause last-minute delays or contract breaches. Chapter Snapshot: What you should be able to explain. By the end of this chapter, a real estate professional should be able to describe the basic components of a mortgage loan: principal, interest, term, amortization. Distinguish between FHA insured, VA guaranteed, USDA guaranteed, and conventional loans, including general borrower and property eligibility. Explain the role of the mortgage loan originator and why both borrower and property must qualify for a given loan program. Compare common loan structures, such as fixed rate, ARM, fully amortizing, partially amortizing, interest only, and negative amortization. Identify examples of seller financing, purchase money mortgage, wraparound, contract for deed, and special purpose loans, construction, bridge, home equity, blanket, reverse. Differentiate between closed-end versus open-end, and secured versus unsecured loans. Recognize the importance of TRID and the closing disclosure timing in coordinating a smooth closing. In the next chapter, you will build on this foundation by examining how lenders qualify borrowers and properties, including debt-to-income ratios, credit analysis, and key underwriting standards that affect your client's ability to obtain financing. 1. Why do you think different borrowers choose different loan programs: FHA, VA, conventional, USDA? Answer: borrowers have different financial profiles, credit histories, down payment resources, and property locations. FHA works for lower down payments and flexible credit. VA works for eligible veterans seeking zero down, no MI options. Conventional loans work for strong credit borrowers who want the lowest long-term cost. USDA works for low to moderate income borrowers in eligible rural areas. 2. What advantages might a buyer gain by choosing a fixed-rate mortgage instead of an ARM? Answer: a fixed-rate mortgage gives long-term payment stability and predictable budgeting. Borrowers avoid future payment increases and are insulated from rising interest rates. 3. Why is it important for real estate agents to understand the TRID closing disclosure timeline? Answer: because delayed paperwork can delay closing, breach contract deadlines, or jeopardize earnest money. Agents must ensure all parties are prepared, deadlines are met, and the buyer receives required disclosures on time. 4. What risks are associated with seller financing options, such as wraparound mortgages or land contracts? Answer: the seller might fail to pay the underlying mortgage in a wraparound. A due on sale clause might be violated. In land contracts, buyers may lose equitable interest if they default, and foreclosure protections may differ compared to standard mortgages.